Good day everyone, I'm Najara Dimatunday from Group 2, Section ZZ, and this is the continuation of our report about Chapter 4, the internal assessment. So let's begin with what is investment decision. An investment decision, also called capital budgeting, is the allocation and reallocation of capital and resources to projects, products, assets, and divisions of organization. So this simply involves identifying, evaluating, and selecting among projects that are likely to have a big impact on a company's competitive advantage. An investment decision can either be long-term or short-term decision. An example of long-term is purchasing machineries for productions, while a short-term is related to levels of inventories. This function required to successfully implement strategies because a firm should carefully pick where to invest in order to gain the highest conceivable returns. Another function is financing decision. This determines the best capital structure for the firm and includes examining various methods by which the firm can raise capital. An example of this is issuing stocks and selling assets. So basically, this function is concerned with the capital structure of the firm. So in order to indicate whether a financing decision is effective, the organization must consider computing debt-to-equity ratio and debt-to-total asset ratio. Debt-to-equity ratio evaluates how much leverage a company is using. So that means na kapag higher ang leverage ratios ng company or stock, it is a high risk to shareholders. While debt-to-total asset ratio determines the financial risk of a company. The lower the ratio, the safer the company. The third one is dividend decisions. This function is concerned in issues such as the percentage of earnings paid to the stockholders, the stability of dividend paid over time, and the repurchase or issuance of stock. Dividend decisions determine the amount of funds that are retained in a firm compared to the amount paid out to stockholders. So, dividend decision is indeed an important one for the firm as it may influence its capital structure and stock price. There are three financial ratios that are helpful in evaluating a firm's dividend decisions, and these are earnings per share ratio, the dividends per share ratio, and the price earnings ratio. Now, let's get into the basic financial ratios. Financial ratios are computed from an organization's income statement and balance sheet. These ratios measure the relationship between two or more components of financial statements, and they are used most effectively when results over several periods are compared, from balance sheet and to the change of equity. In fact, ratio can be used to evaluate various aspects of a company's operating and financial performance, such as its efficiency, liquidity, profitability, and solvency. Indeed, financial ratios plays a vital role in determining whether the company is operating effectively. An example is the trend analysis. Trend analysis evaluates an organization's financial information over a period of time. The goal is to calculate and analyze the amount change and percent change from one period to the next. As we can see in the figure, the current ratio of the company decreases every year from 2006, 2007 to 2010, while the current ratio of industry average is lower in 2006 but greater in 2009 and 2010. So as we compare the current ratio of the company and the industry average, the company's current ratio is greater than the industry average current ratio in the year 2006 to 2008. This means that the company has the ability to generate cash. However, in the year 2009, the current ratio of industry average is greater than the current ratio of company. This means that the company is at high risk. Now, these are the basic financial ratios: liquidity ratios, leverage or power ratios, profitability ratios, and growth ratios. Liquidity ratios is the firm's ability to meet its short-term obligations. This is also used to determine whether a debtor has the ability to pay off its current debt without raising external capital. The common liquidity ratios are current ratio and quick ratio. The current ratio measures a company's ability to pay off its current liabilities with its total current assets, such as cash, accounts receivable, and inventories. So, the higher the ratio, the better the company's liquidity position. The formula of current ratio is equals to current assets divided by current liabilities. Quick ratio measures a company's ability to meet its short-term obligation with its liquid assets and therefore excludes inventories from its current assets. Leverage ratios are used to determine the relative level of debt load that a business has incurred. These ratios compare the total debt obligation to either the assets or equity of a business. The third one is profitability ratios. This measures management's overall effectiveness as shown by the returns generated on sales and investment. So basically, this is used to evaluate the company's ability to generate income as compared to its expenses and other costs associated with the generation of income during a particular period. This ratio also represents the final result of the company. Some common examples of profitability ratios are gross profit margin, operating profit margin, net profit margin, and etc. And the fourth is growth ratios. It measures the firm's ability to maintain its economic position in the growth of the economy and industry. These ratios can give an indication of how fast a business is growing. For example, one type of growth ratio is sales percentage, which compares current sales to those of the previous year. Net income percentage takes sales growth a step further by showing profit after subtracting operating costs. Let us now move on to product operation. The production operation function of a business consists of all those activities that transform inputs into goods and services. The production management deals with inputs transformation and outputs that varies across industries and market. The functions involved in operation or productions are process, capacity, inventory, workforce, and quality.